We'll be starting. Thank you, everyone, and welcome to the webinar. Today, we want to discuss the next steps on Russian oil and gas sanctions. So the event will look as follows. After the introduction, I'll tell you some basic, rules how we're going to interact today, and then we will have 3 presentations in a row. First will be the Ben Hilgenstock. Ben will talk you through Russian macro and why, from this perspective, the energy sanctions are important. Then we're going to have Boris Dodonov, our energy expert and head of Center of Energy and Climate Studies. And Boris will walk you through the expected effects of the sanctions on Russian energy export revenues and the overall situation on the energy market. And then will be Jacob Nell. Jacob is Senior Research Fellow at the KSE Institute, and he has, before that, he worked in Morgan Stanley, BP, and we all, I want to say, are members of the Yermak-McFall group on Russian sanctions, and through all this period of time are heavily involved in, proposing different ideas to finally to make effect with sanctions on Russia. So we will have these 3 presentations, and after this, we will have a session of questions and answers. If you want to interact with us or pose a question, you just write it into the chat. So everyone who is in Zoom can write into the Zoom chat. And those who are watching through Facebook streaming, through the video, we can get your questions in Facebook, basically in the comment. So our communications team gonna collect the questions and pass it to us. So basically we will see it, and we will really welcome your comments and questions. So just to jump over and to start the presentation, I would like to, highlight that we really hope to have the war over as soon as possible. And for this, we need sanctions to be impactful and aggressive. Of course, they should be smart in a way that they should not have negative obsolete effects for the third countries, and they should hurt Russia more than they hurt or create negative consequences for the countries that impose the sanctions. So when we are proposing these ideas, we take it all into the account, and we will walk through these effects. But again, it's very critical for sanctions to have effect, so that Russia would have less resources to wage the war, and the Ukrainian military forces and defense would have, really support through these economic measures. And given that on February 5th, it should be the start day for oil products embargo in EU, and that's why right now, before this day, we hope to talk through the price cap on crude oil and also on the oil products, maybe to have some impact on this discussion, and therefore we would really welcome your thoughts on that. And we see that there is a lot of opportunities and a lot of the price cap, if it's done correctly, energy sanctions in general, if done correctly, can have detrimental impact on Russian economy. So it's critically important. So with this short intro, I'm gonna pass the word to Ben Hilgenstock, Senior Economist at KSE Institute. Ben, please, let's go to your presentation, and let's start with discussion how all these sanctions over the past year and impacted Russian macroeconomic situation, and what you see looking forward.
Thank you, Natalia. So what I'm going to try to do in this first section of the event is to kind of set the scene for what my colleagues will then elaborate on with regards to the sanctions that we propose and specific developments in the energy sector by telling you a little bit about recent macro developments in Russia that we think are important in this context. And there are really three takeaways in our view. Number one is that the Russian economy is approaching a turning point in 2023. And number two is that the vulnerabilities that we see materializing this year are already visible in the data. And number three, that at this critical junction, targeted new sanctions, including on Russian energy exports, could really make a difference, affect the Russian economy, and most importantly, Russia's ability to continue the war in Ukraine. Now, the first topic that I want to focus on is Russia's external accounts, which for a long time had really been a big strength, but that seems to be in the process of changing. You see on the left-hand side in the chart that Russia's current account balance in the last quarter of 2022 reached $31.4 billion, which is the lowest reading since the first half of 2021. And if we zoom in a little bit more to the monthly data, December was particularly weak with a surplus of around 4 billion, which was the lowest since the COVID year of 2020. There are several factors here that are responsible for this development. There's the EU embargo on Russian crude oil that went into effect on December 5th. There's Russia's voluntary reduction of gas supplies to Europe. There's also weaker prices, global energy prices, and then there is the larger discount on Russian oil that we have been observing definitely since the start of the war. Now, all of this did not really have a big impact on the 2022 numbers. You see on the right-hand side that the current account surplus reached $227 billion in 2022. That was by far the largest on record, almost twice the size of last year's surplus, which was already elevated due to higher energy prices. But 2023 and 24 will be very different. We think that the surplus will come in significantly below $100 billion a year, which is already kind of a critical level for the Russian economy historically. And there's room with new sanctions, targeted measures to reduce the surplus even more. The same factors that I just described with regard to the external balance also have an impact on government finance. The budget deficit in December was 3.9 trillion rubles. That's the highest we've ever seen. And while a larger deficit at the end of the year is pretty common, this was particularly large. And it means that for the full year, the deficit was about 3.3 trillion or 2.9% of GDP. That doesn't look too large at first glance, but it is importantly an almost 5 trillion ruble shift compared to the budget that was adopted before the invasion. And it would have been even worse. You also see that on the left-hand side, without significant contributions from Gazprom in the form of dividend payments and a special tax. In total, the Gazprom contribution to revenues was about 1.8 trillion. So the deficit would have been much larger, and also for most of the year, high energy prices really supported revenues. Going forward, we think that the deficit is going to widen as the economy slides deeper into recession and as both export volumes and prices for energy decline. And I want to highlight this is kind of a baseline scenario. The deficit could be significantly wider as well. Now, the wider deficit has important implications for government financing and for macro buffers. First, I want to talk about the National Welfare Fund, which has for the longest time been talked about as part of this Fortress Russia concept of lower vulnerabilities. You see on the left-hand side withdrawals from the National Welfare Fund in 2022 for support of the budget and struggling companies, a lot of them state-controlled. 3.2 trillion rubles overall were taken out of the NWF last year, especially in December due to the high deficit that I showed you on the previous slide. And on the right-hand side, you see the development of the National Welfare Fund from January, the last full month before the start of the invasion, to now. And importantly, the NWF has lost a lot of high-quality assets, including in euro. That's about 70% of the previous euro holdings and 100% of holdings in pound and Japanese yen. And that reduces the liquid portion of the NWF to about 6 trillion in December. Current budget law allows for 4.2 trillion from the fund to be used for budgetary purposes in 23 and 24, which would largely deplete this important macro buffer, or at least the liquid portion of it. We think that larger deficits will accelerate this process significantly, and the fund will largely be depleted before the end of this year. Now, a final point on government financing. Another component here is issuance of domestic debt. Issuance, you see that in the left-hand side chart, in the last quarter of 2022 was the highest on record. And wider deficits will require this to continue in 2023 and beyond. In January to date, 200 billion rubles in OFCs have been issued. What is important is that the larger issuance and the absence largely of foreign investors, which previously played an important role for this market, mean that the cost of funding is rising significantly. On the right-hand side, you see yield curves for OFCs, comparing the pre-war numbers with the peak in the month after the invasion and the latest values in the light blue. And you see that on the long end of the yield curve, there is a significant increase in the cost of funding. And that means that debt service costs will inevitably rise in the future. So let me wrap it up here and hand it over to my colleagues, but happy to answer any detailed questions you may have on Russian macro in the Q&A session. Thank you.
Thank you very much, Ben. So we will turn to questions after two other presentations. I would like to remind you that we're going to accept them in the chat. So with this, I would like to pass the word to Boris Dodonov. So Boris, please tell us what has been going on with the energy market, with Russian gas and oil during the last year. And yeah, what is the scene, as Ben mentioned, for the effect of the energy sanctions in this year?
Good evening, ladies and gentlemen, or good afternoon or good morning, just depends from the country you joined. I'd like to make a brief overview of Russian oil and gas exports since the invasion and present the KSE Institute estimates and for 2022 and projections for 2023. The first slide, please. Total Russian oil and gas products exports amounted to 7.8 million barrels per day in December 2022, which is only a bit lower than January-February pre-invasion level. Monthly export revenue, however, dropped to $12.6 billion in December from around 20 billion in the first half of a year due to both lower prices and wider discounts for Russian origin crude and products. At the same time, the structure of Russian export changed substantially as Russia rerouted most of its crude from the EU to India, China, and Turkey. In December, the share of India in Russian oil exports increased from just 1 to 21%, while the share of China increased more modestly from 20 to 24%. And the discount on Russian main export grade Urals rose drastically since the invasion. It increased from just below $2 per barrel to $35 per barrel in the second quarter. Then it decreased to $30 but then it widened again to $35 per barrel in December after the EU embargo on crude oil came into effect. Both oil export volumes and revenues are projected to decline further as the EU ban on crude and products will come fully into effect on February 5th, 2023. The next slide, please, the gas. Yeah. Russia is losing the gas battle it's waging against the West. Before the invasion of Ukraine, 65% of Russia's total exports by volume went to Europe and around 90% by value. Russia has sharply curtailed gas export to the EU to blackmail EU, but this effort has failed as the EU retaliated by both increasing supply from alternative sources, mainly LNG and pipeline gas from Norway, and as well as implemented effective demand restraint measures. At the same time, Russia will not be able to redirect the gas to other markets. The International Energy Agency forecast its production cut by 111 billion cubic meters in 2022 and almost 140 billion cubic meters in 2023. Overall, Russian oil and gas financial losses are estimated by the IEA at $1 trillion by 2030 compared to no invasion scenario. Next slide, please, Ben. The recent KSE Institute study models the different scenario of Russian oil and gas revenues in 2023 and 2024. We estimate total Russian oil and gas earnings at $357 billion in 2022. In the base case, with oil price cap at around $50 and status quo of sanctions, revenues will contract to $182 billion in 2023. In the bull sanctions case, with US $50 per barrel discount on oil and price cap on gas prices, revenues will fall to a record low $120 billion. And finally, in the bear case, with the US $10 per barrel $10 per barrel discount to Brent prices, which corresponds to $70 per barrel price cap, and less decline in oil export volumes, revenues fall, but will remain at still rather robust $242 billion in 2023. And to conclude, keeping Russian oil at $35 per barrel, and along with robust enforcement of oil shipments, sanctions will effectively curb Russian oil and gas revenue and helping bring the war to an end. Thank you.
Thank you very much, Boris. So then we go to our third presentation by Jacob Nell. Jacob gonna talk about the maybe higher level strategy of sanctions on the energy sector of Russia, and we'll talk through some additional proposals on what can be done else in addition to what has been done so far. Jacob, the floor is yours.
Great, thank you, Natalia, and thank you all for joining this afternoon. So Ben's set out the signs of pressure, of tension, of financial fragility that we're seeing in Russia. Boris has set out how sanctions are already massively affecting oil and gas earnings through price, mainly on oil, through volumes on gas. Now, I'm going to sort of step back a little bit and talk about Russia's dependency on oil and gas, why I think this is absolutely central to an effective sanction response, and build up a package which we think takes you from the base case that Boris outlined to our bull case, which we think will accelerate the point at which Russia struggles to continue financing this war. So I think should be part of a big bang package to maximize pressure on Putin. So let's start out with Russia's oil dependency to set the scene. If we could have the next slide. John McCain used to compare the Russian economy to a gas station, which was a little bit unfair, but has a great essence of truth to it. So what these charts show you is two things, really. The long run historical chart on the left is just to remind you what a traumatic and volatile time Russia has had. So you had big contractions in the 1880s, in 1905, First World War and the Bolshevik Revolution, the war that's not captured really in the data because the data wasn't collected for several years, and of course in transition in 1990. So every generation has had a traumatic wipeout of savings and a deep contraction. So you're dealing with psychology of people who are sort of mentally trained for the worst. Hence, when problems start in Russia, people rush to the banks to withdraw their deposits. They rush to change their rubles to something likely to be more valuable, like FX or property or anything. So you have that underlying fragility from history on your left. And on the right-hand side, I think it's an amazing chart, actually, because what it shows you, slightly different scales, but the direction is the same. When the oil price falls, growth falls. When the oil price rises, growth rises. And of course, the oil price there is a proxy for oil and gas earnings coming into the economy. It's a very, very powerful relationship. And we believe with our sanctions, particularly if bolstered by our additional package today, you see very, very sharp fall in Russian oil and gas earnings this year, which in turn will drive weaker growth. So that's the growth side of Russia's oil dependency. On to the next slide. We can now talk about the external account, the trade account, as we all know. You can see there on the left-hand side, over 60% of Russia's exports, that's goods exports, are oil and gas. And this really props up their entire balance of payments. So you can see those 10-year average numbers in the chart on the right there that show you that you had this oil and gas surplus, which financed deficits in other goods, in services, in income. So really propping up, as I said, the rest of the balance of payments. And similarly fundamental role on fiscal revenues. If we go on to the next slide, you can see that federal budget revenues, you've had oil and gas revenues have accounted for over 40% of those revenues, and indeed a little bit higher last year on the back of the increase in oil price. And in fact, if you think about the buffer, I'd like to make another point to build on Ben's excellent presentation on the National Welfare Fund. If you have a look at the National Welfare Fund, it's very striking that it's got very few in the way of high quality reserve assets left, by which I mean G10 currencies, is just a small amount of euro, and its programmed use this year, that will take you down to the dotted line, will force them to use up their entire stock of yuan, which is a convertible asset to some extent, although not absolutely straightforward, and they're going to have to start eating into their domestic investments and their gold holdings. And of course, with sanctions on gold, it's going to be quite difficult for them to sell gold at scale. So what we're suggesting here is that they're facing something of a liquidity problem, and their assets are not all that they're cracked up to be, which we think will reinforce the impact of an aggressive, forward-leaning big bang sanctions package. So then on to Boris's point on the next slide. Here we have a dramatic decline, more than a halving in our base case of oil and gas revenues forecast for next year. Why is that important? Well, if you check out the chart on the right-hand side in the screen here, this shows you oil and gas earnings in $1 billion over the last 15 years. Every time you've had a sharp step down in oil and gas earnings, so I'm talking about 2008-9, 2015-16, 2020, you've had a recession in Russia. You've had financial problems in Russia, including runs on the bank, weakenings in the currency. And guess what we have this year? In 2023, in our base case, there's a dramatic fall into the middle of that range. If we add these additional sanctions that we're proposing, that's going to take us down towards the bottom end of the range, and will put the Russian economy in a situation where history says it's going to struggle. Okay, so then let's go on to the sanction side to give you our take on where we are now before I build up the package that we're proposing. So obviously, sanctions initially had a very dramatic impact on Russia. You saw ruble collapse to half its pre-invasion value. You saw the central bank hike rates to 20%. But then, thanks to very high oil and gas prices and earnings, the central bank was able to both support the banking system and was able to ease capital controls because the ruble was stabilized by that big inflow. So both tackle financial and monetary stability. And so you had something of a recovery in the middle of the year. I think it's worth saying it's still a very bad performance. Saudi Arabia, a similar oil exporter, expanded by 9% last year. Russia was down on official numbers by a bit over 3%. We think it was a bit more than that. And it's notable that the revisions in Russian data that we've had, for instance, for the second quarter, have revised down their initial estimates quite seriously. So we think probably more like -5% when it's done, but still nothing like the impact on Ukraine where the war is being waged. However, the key sanctions on oil only started in December. We'll be picking up again in February, and we think that this will provide a context in which Russia is going to contract more seriously in 2023 than in 2022, whereas Ukraine will be, we think, the other way around. So that's our thesis, and we think that further action on sanctions can deepen that blow and hopefully trigger some of those underlying fragilities in the Russian economy. So on to the next slide. Very briefly, in terms of sort of state of play, this is looking across the sanctions coalition, the coalition of advanced economies standing behind Ukraine. What we see here is actually quite a dramatic change. So the light importers from Russia, so US, UK, Canada, Australia, they've banned everything now. Europe, which has the heavy dependency on Russian energy, has banned coal. It's now banned seaborne crude. It's very, very tight restrictions on pipeline crude, essentially a Hungarian exception for the Southern Druzhba, and it's going to ban products in February. So there's only pipeline gas and LNG that are left standing. And as you see, we're going to propose that we should shut down those exemptions by and large. And the other category of Ukraine ally that I'd like to highlight is the East Asian democracies, your Taiwans, your Japans, or South Koreas. They still have a long way to go in winding down their Russian energy exports and stopping their financing of the Russian war machine. So on to the next slide. So I think the idea behind the crude price cap is of course that you cut Russia's oil and gas earnings while maintaining the supply of Russian oil into the global market and avoiding some kind of supply shock. So that goes to this idea of trying to be smart about sanctions so that you hurt Russia more than you hurt the rest of the world. But I think the point we would like to make is that the price you need to incentivize Russian production is very, very low. So Rosneft reports that their lifting cost is in the order of $3 a barrel, and their capital cost per barrel is in the order of $6 or $7 per barrel. So all told, $10 per barrel. And Rosneft, of course, covers nearly 50% of Russian oil production. So we see the average production cost is $10 to $15 a barrel. So you can take the price very low, down to $20 a barrel, and there'll still be a very material incentive for Russia to produce. So we think that we're being quite conservative in setting a target price cap at $30 to $35 a barrel, because first of all, there's a very large incentive to continue to export. And secondly, as oil and gas earnings fall, the ruble will weaken and the cost of production, which is all in rubles, will also fall. And on the other hand, if you look at that chart on the other side of the slide, on the chart on the other side of the slide, you can see that when you get these geopolitical shocks in major oil producers, you typically see a very large fall in production. After the USSR collapsed, Russia oil production fell in half. You had steeper falls in Iran, Iraq, Venezuela, Libya. And we would welcome this. We think this is what should happen over time as Russia loses its markets and it's isolated from the rest of the advanced global economy. And that's fine as long as it doesn't happen too quick, because other sources of supply, as in those other cases, will step up to fill the gap in the market. So our proposal is that we should aim for a target that is a lot lower than today. We've proposed conservatively 30, 35, although we see room for it to go lower. And we're proposing that there should be a ratchet mechanism through successive price reviews to lower that price to the level which will deny Russia even more of those oil revenues that sustain the war. Now, of course, maybe Russia will respond by cutting off supply, but it's going to then cut off its nose to spite its face, because that's its main source of export earnings and budget revenues, or most important source. So we think that that's not a credible threat. They'll probably make it, but it's not a credible threat because it hurts them more than Ukraine and their future customers, the emerging markets that Russia will supply in future, more than Ukraine's allies who have a buffer of oil stocks. So the first thing we can do is to keep pushing that crude price cap down. If it's at the March review, then we would suggest a next step of $10 and another couple of reviews to indicate the direction of travel and the likely destination. If there's a chance, we would have preferred to see that crude price cap lowered now to align with the February 5th product price caps. So then on to the product price caps. Now product is kind of interesting. I think it's like the hidden part of the Russian oil export machine. It's a third of the total, much more than any other major oil exporter, for basically because of tax incentives that oligarch lobbies have put in place, and it's not a very rational arrangement. But this means that it's actually a very big decision in February. And as you can see on the right-hand side, you get quite a lot of variety in different sorts of oil products. Some trade at a big premium to crude, some trade at a significant discount to crude. So the basic methodology is to set the price cap at the equivalent crude price cap level plus an adjustment for the discount, which you can either have as a 22 discount or a pre-invasion discount. You won't be surprised to hear that we favor the more aggressive, forward-leaning options. Here on the next slide, you can see we've calculated some slates of product prices for different methodologies. It's a little bit confusing because prices for product are quoted in dollars per ton rather than dollars per barrel as crude is. But anyway, you can see that the basic picture. You have the market prices there. If we go to a crude price cap with the average 2022 discount, then you'll have a roughly 20% discount on the market price, which in practice is a reflection of the Russia discount that you see across the board. And then there's more aggressive options which we favor, particularly where you can substitute for the Russian product quite easily. Something like, for instance, high sulfur fuel oil might be relatively easy to be more aggressive on that than on diesel, where there is a very large dependency, and that's the main product stream out of Russia. So we think that Russia's going to find this product price cap harder to deal with because the sinks for Russian crude, China, India, Turkey, they are long refining, and they'll struggle to absorb Russian product. And of course, the product gets moved in smaller ships, so it's much more expensive. So that's going to be more of a struggle for them, and therefore more of an opportunity for the sanctions coalition to take a more aggressive stance, in our view. Okay, so on to the next chunk of our package, which is on European gas. And here, I'd like to spend a moment because I think that there's a bit of a conspiracy of silence in the energy industry, which was very, very skeptical about the ability of Europe to cope without Russian gas. And I think it's really striking that we now have not only the biggest storage build we ever saw in last year, we also have the highest level of storage we've ever seen at the moment. That means that the advantage is with Europe, and we say use that advantage. Prices, of course, as you can see on the right-hand side, have adjusted back. They're about twice normal levels, which is still high, but it's not a level which threatens the economy or industry to a significant degree any longer. And we see no reason for it to rise again. European storage will be full in July. They're going to have to take prices right down in order to deter LNG coming to Europe. So rather than let that happen, let's use that 40 billion cubic meter cushion we have over last year to turn the tables on Russia and squeeze the squeezer, the country that tried to throttle Europe by withholding gas supply from the middle of 2021. Okay, so here we go on the next slide. You can see sort of confirmation of Russia's marginal role in European gas supply. We had the largest ever net change in storage from August to December last year, and that was the period when Russian supply was at a marginal level. So kind of roughly the same level as UK and Algeria, massively outranked by LNG and Norway. So we say this is evidence that we can do without Russia. And of course, since Russia has nowhere else to send that gas, doing without it denies Russia the revenues absolutely. Whereas with crude, they can sell it somewhere else, albeit at a discount. Okay, so the two steps that we're proposing are on the next slide. First of all, let's just end the effort to send gas to Europe around Ukraine. Nord Stream is shut, Yamal is shut. Let's shut Turk Stream 2, and let's use the third energy directive to do that, which says that you can't supply gas to Europe through a third party, through a pipeline, unless you provide access to third parties, which Russia doesn't do. And that reason was used in order to deny Nord Stream 2 a license. So we think that the Commission can probably get around that Hungarian veto by using the logic of the third energy directive in order to stop Turk Stream supplies into the south. We'll still allow gas to flow through the GTS, perhaps going to a European Commission level buyer rather than directly to buyers in Europe to stop that being used as an instrument of leverage against us. Partly because that gives Ukraine more leverage and security of supply. And the second measure is, of course, LNG, where shipments increased last year to about 19 billion cubic meters. It's a little bit hard to see. It's the kind of the dark purple, not right at the top, but sort of one down in that bar chart on the right. And that's going to Belgium, Netherlands, France, Spain, Greece, all of whom have, by definition, got LNG and can access other sources. So we would say use our strong gas supply situation, turn the tables on Russia, stop Russian pipeline gas supplies through Turk Stream, and end LNG sales into Europe. And then finally, I love this tweet. If you look at the chart, this German embassy tweet, which is, it's very powerful, isn't it? Here you had Europe's biggest economy heavily dependent on Russian energy, and within less than a year, they're buying nothing. That dependency has gone. And so why are we holding back? These oil and gas companies, instruments of Kremlin aggression, let's put full sanctions on them, which we haven't done before. So that's obviously the state-owned ones, the Gazproms, the Rosnefts, the Zarubizhnefts, Transnefts, Gazprom Bank, that was supposed to be the conduit for energy payments. We're not making energy payments at scale anymore, so why do we need to have an exemption for Gazprom Bank? And of course, the quote-unquote private Russian oil and gas companies, who of course have to be aligned with the Kremlin to do business in Russia. So that's in particular Lukoil and Surgutneftegaz. And then let's do their management and subsidiary boards as well. All the members of it. We're big believers in personal sanctions being very powerful in changing elite opinion. And we can, instead of having little partial sanctions, you can't raise debt and equity, but allowing them to continue to do business, let's have full sanctions with very targeted exemptions on price cap compliant operations or supply permitted under the embargo. So that's our package. You can see it summarized on the next slide. More enforcement, oil product caps down to 50, product price caps in line with $50 crude cap plus a modest discount, a ratchet mechanism for continuing to lower it, banning pipeline gas sales via Russia-controlled pipelines, and banning Russian LNG, and full sanctions on the Russian energy sector and associated banks. So what will this do? Well, we think that this package will take us from our base case to our bull case, reduce Russian oil and gas revenues in 2023 to around a third of the 2022 level, and you're going to see financial fragility re-emerge rapidly. And I'm just going to illustrate a couple of ways in which that can happen. If you look at the chart to the final slide, I'm sure you'll be glad to hear, Russian banks on the right-hand side, you saw that surge in demand for liquidity at the start of the invasion. We think that sleeping dragon of a lack of trust in the ruble in Russian banks, that can be reawoken by renewed pressure. And secondly, if you look at international reserves, similar point to the point about the quality of the assets in the National Welfare Fund. It's when you take out the frozen stuff or the immobilized stuff at the central banks in the West, they basically are out of real reserves, high quality G10 convertible currencies. They're down to gold and yuan, and they're going to struggle to convert them into high-powered reserves easily. So we think that the time calls for courage, and we think that this package will significantly support Ukraine in resisting Russian aggression. So with that, Natalia, back to you.
Thank you very much, Jacob. So while we are soliciting the questions from the group, please write them in the chat, or if you are in Facebook, you can write comments there. And our comms is gonna be gathering and passing these questions to me. So I will jump start maybe, and it's the question to all our speakers. Basically, the opponents, those who are against of the lower price cap, they're gonna say that the embargo itself is already enough distraction for the market, and with price cap or lowering price cap, there will be spike in prices on the market, and it will very negatively influence the countries that impose sanctions. So better kind of go very slowly and not to reduce the price cap on crude oil, and don't do anything drastic with the products. So what's gonna be your response to that? Basically, do you expect that the prices would spike if like starting from February 6th from the embargo, and would they spike more if the price cap is changed or imposed? Like, what are your thoughts on that? So maybe we can go backwards, starting from Jacob, Boris, and Ben. So I just came up with this order, nothing specific about it. And then go to other questions. Mm-hmm.
So I think there is a risk of a supply shock, and that's the motivation for the price cap mechanism. But the current price in the market is around 50, maybe a little bit lower. So going to 50, I think, doesn't change that balance in the crude market. And you can pocket that and then collect a couple of months more data and look around. So on the crude side, I think you have this sort of free option of a first step on the ratchet without triggering a supply shock. And then on the product, I think that's really interesting, because there's some products where Russia is in a market where there is plenty of alternative supply, and you can be much more aggressive. So you don't have to make all the products similar. You can pick out one or two and really screw down the price. And that will be a good test of whether there are wider consequences from doing that. So my answer would be, yes, I do accept that there's a supply shock risk. And so therefore, I believe in going step by step, but we can see 2 steps now that we can take. So let's take them.
Thanks, Boris. Do you like to comment on that?
Yeah, I agree with Jacob. I don't believe that lowering price cap to even to $30-35 per barrel will result in a price shock, and I think Russia will decide to comply with this, at least informally. The market price for Russian oil might decline further down to 40 or even below. Russia, this price cap affected mainly Urals grade price. And if Russia decides to cut off its production, it will have to do it permanently. This Urals is produced in Western Siberia, this old wells, old technologies, and if you shut down it, you cannot just you have to do it permanently. In more modern Eastern Siberia technology, they may put some wells for a longer maintenance, but in if they decide to cut off their supply to the gold market, they'll have to do it permanently.
Ben?
Yeah, maybe two quick points on that. The first being that from all the data that we have seen, and the price cap is now in effect for a month and a half, it does not look like Russian export volumes for crude oil have fallen. So that would be one argument why this does not seem to be a credible threat. The second point I want to make is all these more drastic, so to speak, sanctions on Russian oil that applies to the price cap, but also to the EU embargo, they were communicated way in advance. The EU embargo was decided in June, took effect in December. During this entire period of time, we haven't really seen any large disturbances in the oil market or in future prices, which would lead me to believe that there doesn't seem to be a lot of potential for any kind of panic that would drive prices up.
Thank you. Yeah, that's a very interesting discussion. We spent with Boris several hours today brainstorming that. Yeah, it was nice to hear your comments. So I will go right now through energy kind of questions, and then I see one financial sanctions related questions. So the question, and like please, I'll ask expert to raise your hands or give me a signal that you want to take it. So how important is refining of Russian oil in third countries, like to Turkey and India, for export Russian revenues? How this can be addressed by secondary sanctions? So how important is refining of Russian oil in third countries for export revenues? So Jacob has a hand. Yeah, please go ahead.
So, well, I'd make a couple of points. The first point is that the geography of influence is completely different between crude and product. Your markets that are taking a lot of Russian crude and have taken the marginal barrel, your Indias, your Chinas, your Turkeys, they're long refining and they're very unlikely to want to buy Russian product. So that means that Russia's got to find lots of small markets, since those are the big markets out there, or distant markets with high logistic costs to get rid of the same volume of crude, so a product. So it's going to be a lot more difficult for it. And then the second point I would make is that the very long lead time on the embargo means that people have had the chance to put logistics in place to replace Russian product. There was an interesting example a couple of years ago when the Russians dropped a bunch of hydrochloric acid into the northern Druzhba and had to shut it down. And all the refineries had to put alternative logistics in place. And it worked. It cost a couple more bucks a barrel, but they were able to do it. And that was an interesting dry run because, of course, all the northern Druzhba have now completely forsworn pipeline crude in Poland and in Germany. So I think that with enough lead-in, people can do the logistics to replace Russian product.
Thank you. Is anyone willing to add? No. Okay, then let's go to the next question. So maybe Boris, it's gonna be to you. Does KSE have the information on the presence of oil and gas producing companies that have remained on the Russian market and continue to provide services? So a quick reflection here is that, and I will post it in the chat. So we have pretty detailed information about companies that continue staying in Russia. So I put it specifically linked to the energy companies. There are really plenty of them. starting like with big name as Schlumberger, for example, but maybe, I don't know, Boris, Ben, maybe you would like to comment on some specific cases of the energy companies that continue working in Russia. Okay, Boris, go ahead, please. Mm-hmm.
I'll probably start and then Jacob will add if needed. I just recently met an information that initially it was an announcement that all big four service companies left Russia, and they will continue to serve only their contracts conducted before the invasion. But now that it seems that SLB, the one of the biggest one, they pick up new contracts and they continue making this operation in Russia. And of course, it needs a reaction. First, the company, we need more transparency and probably increase pressure on the West that this company, they have stakeholders, and if this information is really true, the company might lose their market value as well. That it might be a fine, but it's still there is no it doesn't look good, but the company seems to comply with current sanctions. That they don't prohibit to continue and meet contract obligations. While the biggest companies, they just most of them they left Russia. All these projects are frozen, especially in the gas sector. After Nord Stream was Nord Stream 2 was closed, that the whole gas field, the project was closed. Then Vostok Oil was the most ambitious Russian project is either delayed or closed. Russia announced it was expected 2 million barrels a day of light oil to produce on it, but current Western stakeholders left it, and especially in the gas sector, there is no attention. That as all Western companies left this sector.
Thank you. So we will take 2-3 more questions so that we finish on time. So the next question is, do we need special sanctions on Russian LNG? So I think, and I will probably add to this question, maybe if our experts could add a little bit more on what to do with Japan, who is a part of the G7 and sanctions coalition, and is kind of for whom this question might be more critical than for others. So who would like to jump in? I think Jacob would like to. Please go.
So look, I'd say on LNG, I think Europe's in a strong position to say do svidaniya, because we've got this huge storage. Unfortunately, in East Asia, the LNG importers don't have the same amount of storage. So I think it's harder for them to exit LNG. What's happening in the LNG market is there's a wave of supply coming, but it doesn't arrive until 25, 26. Qatar, some of the US projects that got sanctioned at the beginning of last year. And so I think what we should look for from the East Asians, particularly the Japanese, is a commitment to exit and a schedule for winding down. but I think they're not in as strong a position as Europe to stop now. I also like the idea of a price cap on LNG. If we can do it on oil, why can't we do it on LNG? Obviously, Russia has some LNG ships of its own, but not the full fleet. So we'd have to do the numbers on it, but I think that might be an option, as indeed on other forms of maritime transport for Russian commodities, since so much of the price is rent that you can cut the price very dramatically, and it continues to be at a level where Russia has a strong incentive to supply. So let's target Russian rents using the price cap mechanism and explore whether LNG is another place where we can do that.
Thank you, Jacob. So, I'll combine maybe two last questions and ask Ben. So, one is why is there no complete ban on buying Russian bonds on Western financial markets? And second question, I think we can pair them, is how do you believe to what extent energy sanctions are effective in constraining Russia and its military action in Ukraine in coming future, considering the outstanding balance of the National Wealth Fund and the expected outflow this year under base case scenario presented? It leaves Russia with at least 12 to 18 months of fiscal stability, ideally until the National Wealth Fund will run off and ability to continue the war. So basically, like, one is why it's not complete ban on buying Russian bonds, so it's tricky. And yeah, second is like, is there really effect on military action and the overall capacity? So Ben, please.
Yeah, okay, I'm going to give this a shot, and please, Jacob, jump in and add to what I'm going to say. So let me take the question on the bonds first. It is true that the sanctions regime isn't uniform across all countries of the sanctions coalition, but effectively, foreign investors have largely disappeared from the Russian debt market because of US sanctions on sovereign debt. So Russian Euro bonds were sanctioned a couple of years ago already, so everything not ruble denominated, and they have largely disappeared. There are no new issuances. On the OFC, so US persons are no longer allowed to engage in trade with Russian ruble denominated sovereign debt. That means that European investors can also no longer trade these bonds with US counterparts if they wish to, which is, quite common in the secondary market. And then another component here is that foreign investors were never really active in the primary market for OFC, but rather in the secondary market, and were buying these securities from Russian banks that bought it from the Ministry of Finance. They can largely no longer do that because these Russian banks are under sanction. So in effect, this means that foreign investors have disappeared from the market, and we actually saw in the last data release, which I believe covers November, a pretty sharp drop in non-resident holdings of OFC, which is, in our view, not a result of any trading, but rather in the maturing of existing OFCs that these foreigners had held, and their holdings have decreased by about a third within 1 month after not moving at all for a couple months before that since the start of the war. So back to the question, yes, it's not a uniform ban, but effectively foreigners are no longer playing a role in this market. On the second question, on the impact on Russia's ability to continue the war. So first of all, I wouldn't call this necessarily fiscal stability, what we're observing right now. It's already a pretty dramatic shift to the pre-war plans, and it is going to continue to deteriorate Russia's fiscal accounts, that is. There's also some ripple effects from energy sanctions on other parts of the economy, which will then also again affect the fiscal balance and ability to finance the war. For example, Russia's central bank, as Jacob showed you earlier in the presentation, was able to address the kind of crunch in the banking system relatively quickly, which stopped a systemic financial crisis and also a larger effect on the Russian economy. But this was possible largely because there was support from a very supportive external environment. So the CBR was able to simultaneously pursue monetary stability and financial stability. So fighting inflation, but at the same time providing funding to the banking system. With a less supportive external environment, it will no longer be able to do that, but rather have to choose. And we think that the CBR will likely have to hike rates this year, which will then also again weigh on the economy, in turn weigh on certain parts of fiscal revenues. Now, I think the overall problem here is that there are always ways to extend this kind of system of financing this war for a little longer. Banks are largely state-controlled. The government can ask them to fund the deficit. Yes, that drives up yields on OFCs and will drive up debt service costs in the future, but not necessarily this year, but rather later. What is difficult to anticipate here is when exactly the country hits a certain breaking point. We see that all sorts of screws are being tightened, either more or less. When exactly that leads to an inability to finance the war effort is a bit of a tougher question. But happy for Jacob, for example, to jump in here as well and add.
Ben, I think that's absolutely right. Look at the history of Russia, and you see that it's got a lot of underlying fragility, and its periods of strength have coincided with strong oil and gas revenues, and its periods of fragility have coincided with collapses in those oil and gas revenues. And what we're seeing now is a collapse in oil and gas revenues in a situation where you don't have external finance available, and most of their buffers, those central bank reserves that have been immobilized abroad, are no longer available to them. So they're actually in a much more fragile situation than the fortress Russia and the big numbers around nearly 600 million in revenue reserves suggest. And my own experience of Russia is that the crisis can be triggered by quite a trivial thing, some problem with a bond auction, some financial stability event, and that can trigger that surge in demand for liquidity, that withdrawal of deposits, that demand for FX that we saw in the autumn, and we think they wouldn't be able to cope with a second such wave as well as they could last year with those strong oil and gas inflows.
Thank you. So maybe 2 cents here is if you look into behavior of Russian, they really reacting in some more or less rational way to sanctions. For example, when there was this Green Deal negotiation, Russia was explicitly trying to trade for some exemptions in the financial sector sanctions, like desanction some of the banks and also remove some Ukrainian sanctions on the transportation of ammonia through the territory of Ukraine. So in terms of even behavior, Russia is responding in some kind of constructive way to the sanctions. So it's from this perspective, it's also an effective instrument and the only effective instrument if we don't take into account the defense military forces. So I think we will finish right now, and I would like to thank everyone for participating in the discussion today and for very interesting and intellectual stimulating questions. And thanks a lot to our experts for the awesome slides. I hope soon all our proposals will be implemented and the war will be finished. Thank you.
Thank you, everyone.
Thank you. Bye.
Thanks. Bye.